Hello, my name is Patrick, and in this video we're going to be talking about the world of mistakes that directors could make if they're managing their own accounts. Now, as an accountant myself, probably would go out there and say that everyone should have an accountant. Be daft of me not to, but I do know that there are many reasons why people don't need an accountant, and actually I empower that. And that's what this channel is all about, is to empower you as a business owner to be making sure that you're doing the right things for your business, and hopefully making sure that your business doesn't just survive but thrives. And if that sounds good to you, make sure you drop a like, subscribe, and get yourself involved in this channel. So in this video we're going to be talking about the mistakes that limited company directors make and how to avoid them, because obviously that's the most important thing. Let's go. Hello, my name is Patrick. I am a chartered accountant, a certified UK trainer, that QuickBooks Chap on the internet, and also head of accounts here at Boffix. Now in today's video, we're going to be talking about the world of making mistakes and how to avoid them, especially if you're doing your own account. So let's go straight into it, and tip number one to make sure that you don't make these mistakes. Tip number one can be a massive tax saver. Only applicable in certain circumstances, but a way to absolutely make sure that you're maximizing your tax efficiency if you own your own limited company. And it's all about how you remunerate yourself. Because let's be honest, most people do business because they want to be remunerated for the work they're doing. It's going to be very unlikely that you're doing the business just for the sake of it and that you don't want to take a single penny out of it. Most people have mortgages and rent and everything to pay for, and they need to be remunerated for the work they're doing. Now, as a business owner, you have multiple ways to remunerate yourself. You can pay yourself salary, you can give yourself dividends, you could put yourself as a subcontractor if you want to. But what's the most efficient way? Well, if you don't have any other income elsewhere, then by far the most efficient way is to make sure that you utilize your personal allowance by paying yourself a small salary and then paying yourself dividends on top of it. You see, your company is going to be generating profits, hopefully. And if it's generating profits, then it's going to be paying corporation tax. So it doesn't make much sense for you to pay corporation tax and a load of PAYE and a load of other taxes. You want to be making sure that you are keeping that as efficient as possible. And by far the best way of doing that is declaring yourself what we would call a director's salary. Now, the director's salary is designed to be at a certain level. That level is to make sure that you get your national insurance stamp each and every year, and also making sure that you don't incur any other taxes for taking out that salary. Roughly, that equates to around about £12,000 at this point in time. Now, you want to be making sure you pay yourself that on a month-by-month basis. You then want to be making sure that you take dividends on top of that to keep yourself going. Now, there's a whole pitfall for making sure that you don't keep on top of what profits you have and what dividends you can. So having good, strong accounting is going to be essential for this process. QuickBooks Online is our recommendation. Use our e-store below to get yourself a nice little discount on it as well. But you need to be making sure you have enough profit so that then you can pay dividends and keep it really nice, tax and efficient. There's a lot of pitfalls that can be done, so you need to be on top of this massively. But if done right, this is by far the most tax efficient way. You get yourself a nice tax-free salary, you get yourself a stamp each and every year, and then you basically top that up with dividends, which at 7.5, 8.25%, if done correctly, is by far the most tax efficient way for you to remunerate yourself for all that hard work you do in your business. So take some advice from an accountant. Have a look and consider if taking that director's salary is right for you. And please, please, please don't miss out on that great tax saving if you're not paying yourself a salary and you're not being remunerated for your work anywhere else. If you have a zero income at this point in time personally, then it makes a lot of sense to be making sure that you pay yourself that director's salary. Tip number two, moving on from paying yourself that direct salary is paying yourself dividends, but making sure you get that balance right is absolute essential. Now, there's two things to consider. First of all, to make sure you have enough reserves to pay that dividend. Paying yourself what's called illegal dividends, which is dividends that you didn't have the profits to declare, can lead to some catastrophic effects to your personal tax in form of what's called a P11D for a overdrawn director's loan account. You definitely want to stay away from that. The other thing to remember is a tax called Section 455, which is all about a director's loan account which is overdrawn at a year end. And again, from your company's point of view, you need to stay away from it. It's a very, very painful tax to be subject to. But that's not the end of the story when it comes to dividends. You see, dividends are very, very, very tax efficient if you can pay them out on what's called your basic rate. And your basic rate of tax is 7.5 or 8.25% at this moment in time. And if you think about it, that's quite a low effective rate of tax to be incurring on withdrawing money out of your business. Problem is, if you go from basic rate to higher rate, well then suddenly you're in a world of pain. That world of pain is going to be jumping up from 7.5 or 8.25%. I hate that extra 1.25%. It makes things so much more complicated. And also go up to that 32.5 or 33.75%. Now, as you can see, when you jump from 7.5 to 32.5%, that's a huge jump. So most of the time, it's all about being efficient in the way you take dividends. Either split them between multiple years if you have the opportunity to, or if it's applicable, bring on more members of your shareholders who can start taking shares out that's based on yours, especially if you've got a significant other and want to be making sure you're utilizing their band, their basic rate band, can be a really effective way. Also, don't forget a very good tip in the fact that you have £2,000 worth of dividends tax-free every year for each person. So if you know someone who's not utilizing that £2,000, that could be another way of making sure that you're as tax efficient as you possibly can. So make sure you get that balance of dividends right. Director salary, dividends, too much salary, you're going to be paying too much tax. Too much dividends, you may incur the fact that you haven't got enough profits in your business, and you could really hit some very, very nasty taxes if not careful. Tip number 3 we've already touched on, and that is about making sure you're utilising that shareholders. At this point in time, the more shareholders you have, the more efficient you are going to be at taking dividends out of a business. The more shareholders you have, potentially the more of those £2,000 worth of tax-free dividends you can take out. The more shareholders you have, the more you can take at basic rate, which is only 7.5% compared to 32.5%. And then finally, the more shareholders you have, the more opportunities you have to be able to make sure that you utilise any potential personal allowances that aren't being used elsewhere. At this point in time, the name of the game is to try and make as many shareholders as you can to maximise the way that you're taking dividends out. If you just had one shareholder and took out all of the dividends out, it's going to cost you a lot more than it would do if you're able to spread that between multiple shareholders. So have a look at your structure of your business, see if there's any way you can make the most of that and be able to spread that around. Some key tips here: do make sure that you don't give away control of your business. Control is far more important, in my opinion, than any tax efficient route there's ever going to be, because control is who owns that company ultimately, and you want to be making sure it's you in most circumstances. And also don't forget that you want to be utilizing what's called alphabet shares, just to give you that little bit of flexibility in terms of how you're paying out dividends going forward. And my Brucey bonus tip: just make sure whatever way you do it, if you're going to be dealing with dividends and paying yourself out dividends, make sure you're on top of your bookkeeping. Because making sure you're on top of your bookkeeping means you know how much profit you have to be able to pay out dividends in the first place. You know if your director's loan account is going to be overdrawn, and also you're going to know if you're on top of making sure that things like your payroll and everything else has been actually completed. Again, our recommendation is QuickBooks. Use the link below for some discount on QuickBooks Online itself, making sure that you can pay yourself dividends, pay yourself salary, and keep yourself nice and tax efficient. My name's been Aaron Patrick. Hopefully this video has been able to give you some inspiration on making the most out of your business. If not, make sure that you use the comment section below. We're always answering the comments there, or reach out to us on the link tree below. Our role is to make sure that you as a small business owner gets the most out of your business. We want all businesses not just to survive, but to thrive. And making sure that you remunerate yourself in the right way is definitely one of those ways we can achieve that. My name's been Aaron Patrick. This video has been an absolute pleasure to do, and I will see you in the next video. Bye for now.